Me?
Yes. All right. I think everything is set up correctly now. All right. Well, good evening, everyone. Thank you so much for attending this month's market update webinar. People are still filing in, but we'll get started with disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only. It does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing anything discussed within the presentation. And of course, past performance is not a guarantee of future results. You can learn more about our disclosures on our website. And throughout the webinar, please feel free to use the Q&A button at the bottom to submit any questions that you may have. Quick bio about myself. My name is Jeremy Eppley. I'm a certified financial planner, certified private wealth advisor, and have a master's degree in personal financial planning. And we have another guest panelist here today, Gordon. He joined Silverstone from Your Best Path a month and a half, 2 months ago. And we're finally able to have him as a part of our monthly webinar. So for those of you that are meeting him for the first time, hopefully we'll be able to see him a lot more on these webinars and have his a little bit of his experience and knowledge contribute to all of us. It will be great. He's also a CFP, also a chartered socially responsible investing counselor, CSRIC, and has an MBA. Anything you want to say before we get started, Gordon, or can I hop right into some news?
Well, just that I'm excited to be here, and it's just been great as we continue to integrate our practices, and I just really appreciate all of our audience. Looking forward to getting to know some of your people and your clients, and I'm sure my clients will be very appreciative and excited to get to know you.
Awesome. And for all those that are watching the recording, we host this monthly on the first Wednesday of each month at 6:30 p.m. But if, of course, you can't make it, the event is recorded and posted to our YouTube channel. All right, let's hop in. For those of you that have been here before, you'll recognize what this is called a heat map. Is one of my favorite ways to look at the markets. The larger the square, the larger the company. They are also sorted into various industries and sectors. The redder the square, the more that that the company had lost in market share or market value rather, and the brighter green means it outperformed or performed quite well during this period. So this chart is specifically showing the year-to-date performance, year-to-date 2025. So January 1st until today when I ran it. Performance, of course, has been down since January. There's been a lot of volatility, which we will be discussing at length throughout the presentation. But what you can see is that S&P 500, usually the most commonly followed index to track the stock market, was down about 5% year to date. The top 50 companies which have been outperforming, these are what we call mega cap companies, the ultra large, they had been outperforming for many years. There are good reasons to consider that they might continue to outperform, but just so far this year, for the past 3 or 4 months, they performed worse at a loss of 8% instead of 5% of the broader market. A lot of that has to do with Tesla, which you can see is the brightest, reddest square here. A lot of that, which we'll also discuss, has to do with Elon Musk, the CEO of Tesla, and his involvement with politics and it having a negative impact on the company. Small caps, which are the smallest publicly traded companies, still massive companies in comparison to like a mom and pop store or a small independent company, but smaller in comparison to Google or Amazon or Apple. They performed worse than the general market, losing 12.9, almost 13% year to date. However, to see some positive returns, we see global ex-US equities, so that is non-US companies, non-US stocks, outperforming the US markets. A lot of people have fled the US markets due to the administration's tariff policies and general fear about the US economy due to all these unprecedented changes that are being not only proposed, but actually invoked and being put in place. We also see a similar story being played out with bonds in general returning 3% year to date. That's both the bonds become more valuable, but also the interest that they have paid. And gold being up 25% year to date, which is a big jump for gold, which shows fear usually or inflation concerns, where gold is seen as a protective asset that you can run to when bad things are happening. The really interesting one that honestly flew under the radar for me until I was preparing this webinar today was crude oil being down 20% year to date. There are probably lots of reasons. Oil is one of the largest markets in the world, so there are a lot of contributors, but it might be due to the drill baby drill quote from Trump of trying to increase oil production, but could also be various Middle East or Russian influences based on their production. But it's interesting to see oil falling since it is a big contributor to inflation, since it trickles down to plastics and trickles down to gas, and lots of other goods and services come from that base commodity. Bitcoin, honestly, I think this is the lowest percentage change I've seen on any of the graphs I've put up for Bitcoin for the multiple years I've done this, being flat 1%, which is still a big move for some asset classes over 4 months. But for Bitcoin, it's actually surprising to see anything start with a zero when we're talking about that. All right. This is another graph for those of you that have attended before that I really like to show. This shows the seasonality and the cyclicality that's normal in the stock market. The outer circle shows historical returns for each month. So this average returns. And the inside circle shows what actually happened for this year. And last year, we honestly followed the trend somewhat closely. Of course, there were a couple months that had some anomalies, which, since these are averages, we'll never follow it exactly. But this year, we've really bucked the trend. It has not followed it at all, mostly because these are unprecedented times. A lot of the administrative changes that have been put in place are not your average month over the past 100 years or so, or 70 years, however long. This is from 1950 to 2017, the data. So it's definitely not the average month, so you shouldn't expect the average outcome. But normally, February, March, April are pretty good months from a seasonality standpoint of the stock market. Now, they've been quite bad. And what does that tell us? It doesn't tell us very much. Again, past performance is not a guarantee of future results. May and June are usually not particularly strong months. However, there could be an argument to be made, well, markets have fallen, therefore these next 2 months will likely be more positive than normal because they're making up gains. Or it could be way worse because it's an ongoing trend where markets could continue to sell off. With this chart should not be seen as a good predictor. It's just an interesting dynamic of the markets to watch. And so far this year, it has not been following normal trends. All right, this will be my last slide before Gordon here will have some things to say. But this is a normal S&P 500 chart. So when we say normal, this is actually called a candle chart for those of you that don't follow finance too closely. Each of the candles, why it's called a candle chart, is it has a box and it has a line on either top or bottom of the box, and that's called the wick. And for if you see a red candle, that means the day opened high and closed lower. And if it is a green candle, it's the opposite. It opened lower than it closed. The name and the mechanics of the chart doesn't actually matter. The importance that we want to show this chart is seeing the volatility and how much the market sold off from peak to trough down here, where at the beginning of March, tariffs essentially were finally announced. They had been discussed very much on the campaign trail, but the actual tariff policies were starting to be more solidified, if you can call it that. So even since there's a lot of volatility even in the policies, but they started being announced, and then right here at the beginning of April, they were actually implemented. Big sell-off, and then within a week later, a lot of them were pulled back off, and we saw it jump back up. There's still a whole lot of uncertainty about what the tariff policies will end up being or the impacts on the market. But I wanted to add these few lines here to remind us where we were and to hopefully put into context your current portfolio. There's actually a term in finance called anchoring, where it's a psychological feeling where you look at your portfolio and you anchor to the highest point. So your portfolio is worth whatever it was worth in February or in March. And now that is down significantly, it's very painful and fearful. But if you zoom back out right before the election, we are about even, slightly above, or I guess slightly below, but about even when the election took place. If you go all the way back to the beginning of 2024, we're still up. And when we had the big dips and we're at the very bottom, we were still even to where we were at the beginning of 2024. So don't freak out too much. I know Gordon has more to say about all of this. The last point I'll make here is you can see these what are called short candles, and it talks about low volatility, where it opens or closes the days of the markets not significantly different. Versus when you see these really big candles, that's what the actual visualization of volatility. So if you are hearing these headlines and is making you very stressed, it's because this volatility is coming out of the risk has been there, but now actually experiencing it is different for investors. So there are various ways to look at it, and I know Gordon has some points to discuss about how to not freak out too much about these volatilities and these swings.
Yeah, so if we go to the next slide, I want to zoom way out, all the way to 1950. And this chart was one that I did for my newsletter a few weeks ago when we were at the bottom of that V on the last chart on the right side. And so we see, yes, right. Mm-hmm. So we see that that day, 30.36,000%. That's how much up it was from 1950. But the number on the scale doesn't matter, isn't my point here. My point is that there was this big drop, and it looks big on the graph, but we look back and we see we're still higher than we were at the last peak, which was that first arrow is pointing toward a peak, which is right when the Fed started raising interest rates, and we had a decline because it was those 9 months were the fastest rise in interest rates in modern history in the US. And so that caused a decline, but it bounced back, and went on to exceed that. And so then the next arrow, as we go from right to left, the next arrow is pointing toward a dip that we had. That was COVID. And remember, when COVID was happening, we had you know fears of unemployment being depression level 20-30%, and the markets reacted very swiftly. But the Federal Reserve again took quick action, after a few weeks of that, and dropped interest rates to zero, and we had a recovery. We started working on vaccines and things. And so then the next arrow back, that's the great financial crisis. And that was kind of a wider decline. It was longer lasting before we recovered. And the arrow before that was the dot-com bust. And so those were massive disruptions. But when you look at it now in terms of this big scale here, this 70-year scale, they're kind of blips. And in fact, the biggest one-day drop ever is this arrow over there, the last arrow. That was the 1987 flash crash. What happened in 1987 is we just started having what's still called program trading, where you would have an algorithm deciding that, hey, if the market goes down this much, we're going to automatically sell to prevent further losses. And some short-term trading firms were starting to use these algorithms. And what happened was, one algorithm would fire, and that would cause some other firms, and it just became this vicious cycle. And the market went down something like 40% in one day. And now it looks like a tiny little blip. I had just graduated from college back then, and people were terrified. Oh my gosh, how are we going to manage this? And they figured it out. Now they have a system of breaks, where if these programs start firing off and causing each other, then they turn them off, and they just say no more algorithmic program trading is allowed, and give people a chance to catch their breath, because the machines are making decisions so fast. So that's a little context for how the further back in the past these things are, the less significant and fearsome they seem in hindsight. So let's look at the next slide, please. And the other way that I like to think about these things to give a really broader perspective is, a key part of our investing strategy is, and I think any good investing strategy is, that we want to match up the time horizon of your goals and your investments. And so if we have near-term goals funded by assets that don't fluctuate very much, then we know that we're secure for that duration, maybe 2, 3, 4 years, depending on whether you're retired and how much room for error you have in your own personal situation. And then our long-term goals, we fund with long-term assets, which, while we may have disruptions like COVID, or even long disruptions like with the financial crisis, still over 10 years or more, stocks are almost always the best performing asset. 13 years, I believe there's never been a period in the US where stocks didn't go up over 13 years when we look at a diversified portfolio. Obviously, one company can go down and stay down forever, but so that's my spiel on kind of the benefit of thinking long term for your long term goals and investing long term versus um, keeping the volatile stuff out of assets that you may need to tap into in the short term.
And I'll add that's for most of our clients, that's what we structure portfolios in a way where we separate them out. Where there's the term called a bond ladder, where we have bonds in a separate portfolio where you're living, if you're a retiree, you're living off of those bonds for however many years you need to feel comfortable, and then the rest you put in the market that has some volatility. Different advisors, not necessarily a better way or a worse way to do it. Other advisors sometimes blend them all together into one portfolio that has bonds and stocks, and it mutes how much the volatility occurs. But actually being able to see the difference of this is my money for my near-term goals and this is money for my long-term goals helps prevent that fear of, well, I need to sell because the market's going down. Well, not necessarily. If your short-term goals are covered, then you have the ability to take more risk and ideally make more returns.
Exactly.
Flip past these two. It seems like my slide here got messed up. Let me just fix that really quickly. There we go. Apologies. So now we'd like to talk about some notable events. There were quite a few the past month. I also threw in a couple from the month before that, since unfortunately I was sick and I wasn't able to have the webinar. I still want to talk about it all. So the first notable event that I want to discuss was all the volatility. The stock market drops mostly due to tariffs. So around April 2, different news came out at different times, different announcements and such. But a lot of the big disruption came around April 2nd when the Trump administration put tariffs on the whole world, including Canada, Mexico, our allies, and such. And it was unexpected for not only the level of tariffs, but that he actually was going to go through with them, not just that they were campaign rhetoric that wasn't actually going to come to fruition. So when those tariffs actually went to effect, the market crashed. So then the tariffs were then rescinded, and then the market went up, and then they were reinstated, and then they were postponed. There's been a lot of volatility back and forth from the actual just what is happening with the tariff policy, where do we land, what countries have what policies in place, which products are exempt. A lot of it has been done in a way that is not predictable, which causes disruptions for businesses, which leads to poor performance in markets. So we've discussed it. I'm sure there'll be more to talk about next month. I don't see this question going away anytime soon. And we will, of course, keep you updated as new tariff and other changes occur. The next notable event that I wanted to discuss were the various firings that have occurred in different regulatory agencies. And this is a finance webinar. I'm specifically talking about various disruptions in financial regulators. Is not to talk in a more political sense, but what it actually means for the financial markets and you as consumers of financial products and services. So there are two main firings or threatened firings that I really want to discuss. The first one happened on April 16th when the Trump administration fired two, I'm going to put in quotes, Democratic members of the National Credit Union Administration, their board or whatever the top level of regulators were there. Both of the people that were fired, terms weren't set to expire until 2027 and 2029. why I put democratic in quotes is all of the institutions that I'm going to be referring to in this event that I'm discussing are all largely nonpartisan. They're not meant to have political influences. Of course, whatever administration's in power at the time of appointments does have some influence, but whether or not the person that was on these regulatory boards was appointed by a Democrat or Republican, it doesn't actually or shouldn't affect how they regulate some of these financial institutions and financial markets. Some of the other, I will say, debatably legal firings occurred at the Federal Trade Commission, the FTC, the Securities Exchange Commission, the SEC, and lots of other non-finance related regulatory agencies that we won't cover in the webinar. Why I say debatably legal is because the terminations are unprecedented and lawsuits have been filed. They're pending. We'll keep you updated if there are any big changes or unexpected outcomes there. But why I bring all this up from a finance perspective is that it's really worrisome to see specifically regulators purged from their positions without real good justification for their firing, other than like not having blind loyalty to the president. Regulators are really important for the financial institution. You can go back plenty of times, look at 2008 or Bernie Madoff or what's happened with the cryptocurrencies. Not having regulators leads to lacking stability, lacking predictability, preventing bad actors to take advantage of financial markets, consumers, and investors, and basically anyone that interacts with these markets, services, all that. So what I've been very worried about has been specifically the Federal Reserve. I think that is the pinnacle of independence where it should not be touched. Now, Jerome Powell, which is this person on the right here, he's the head of the Federal Reserve. His term is set to expire in May of 2026. Trump, who appointed him originally, has threatened to fire him on multiple occasions. For just about everyone believes that it's not legal for him to fire him. And Trump, every time he threatens to fire him, you can see the markets take a little blip where it drops down. And so far, his latest thing that he said is he's not going to fire Powell. But just from a broader sense of the administration trying to have influence in what a fully nonpartisan independent agency is doing for not only like financial markets, but how money works and how the economy's interest rates are selected. That independence is critically important. I don't know if Gordon has additional points to say there, but super important in my mind that the Federal Reserve is not meddled with, and hopefully that'll be the case.
Well, I agree 100% with everything that you just said, Jeremy. And yeah, it is very interesting that Trump appointed Powell. And, you know, presidents always want the interest rates lowered and from any party, because it's good to in the short term to stimulate the economy. But the Federal Reserve's mandate is to try to generate price stability and not and watch out for inflation. And we can't have interest rates that are too low, or else it'll do the opposite. So the next two things I'm going to talk about, and these are tangentially related, which I'll mention at the end. So the IRS has been cutting staff, and so far it's lost about 11% of its workforce, but 31% of its auditors. The Biden administration had increased the number of auditors, and so a lot of those people were on probation in terms of their federal employment, and so they were easy to get rid of. But 3,600 auditors have been let go. And in fiscal year 2023, auditors generated $32 billion in tax assessments, from finding issues with tax returns, and that's according to the Treasury's Inspector General's office. One advocacy group called Better IRS, which wants tax filing to be free. They think that, instead of having to pay TurboTax or whoever for software, you should just be able to do everything through the IRS website, or have them do it for you. Anyway, they say that every dollar spent on auditing the wealthiest Americans returns $26 in tax revenue. Sounds about right. And Yale's budget lab has said that over 10 years, it could lead to $323 billion of lost tax revenue due to lower compliance, fewer audits. So really, this move is a deficit expanding move. And when we think about that impact on the economy and markets, usually deficit expansion leads to stimulating the economy, more growth. And then, of course, there's always the argument about, how much of a deficit is too much, which we won't get into today. Definitely, that's a very political question. But so while this will have a big impact on the budget, potentially, not much impact on the economy directly, because when it's mostly the wealthy that will benefit, and wealthier people don't tend to spend their money on goods and services. When they get lower taxes, they'll probably they're more likely to just buy treasury bonds or save it, or buy land and things like that. Now, in contrast to that, we have the other item I'm going to talk about, which is the student loan repayments restarting. So 40 million Americans, a little more than 40 million, have student loans, and which is 11% of the people, and 4.2 million, so a little over 1 out of 10 of those are more than 90 days delinquent. And so what's happening is they're going to start collecting on these income-driven replacement options that the Biden administration had. It was called the SAVE plan, where you could put in your loans and how much income you make, and it would recommend one of several different programs. Well, they're still going to have two programs. One is just, pay the interest rate you agreed to for the time period, and the other is an income-based repayment plan, but you have to keep paying for 30 years, whereas under the old plan, I believe there were some that you paid for 10 years and then you would get forgiveness. But or there were different factors that would play into that. So 30-year repayment as a percentage of your income, and you can eventually get some forgiveness. There are some other paths to forgiveness still. There are some public service programs still out there. Teacher loan forgiveness, for example. Some of those have funding from individual states rather than federal government. If you are disabled, or if you're defrauded by your school, or if your school closes before you get a diploma, you can apply for loan forgiveness. And of course, military service, especially if you are going, promise to go into a skill area that is in high demand, you can get loans repaid. but so how will this affect the economy and markets? Well, student loan borrowers are much more likely to spend their money on goods and services when they got those loan reductions. And so closing those programs will be a somewhat of a break on growth and employment. Borrowers will have to spend more on loan payments instead of, on their local businesses and national businesses. So much more likely to have an impact on the total economy than the IRS plan, even though it's similar in size of when you think about dollar amounts, because it's a totally different population of people that it's affecting. It'll have a bigger impact.
Yeah, in economics, the term that he's referring to is marginal propensity to consume. So those that are lower income that have this debt, if they get $100, they're likely going to spend $100. Versus
Exactly.
if a billionaire gets $100, they probably aren't changing their spending pattern. That $100 is likely going to go to saving or investing, which will prop up the stock market, but won't actually affect the economy. So there are various theories and opinions about what's the best use of government dollars, of saving taxes versus spending. It all depends on who you ask, I suppose. Anything else to say about that, or should I move?
No, I'm really interested in these next three, so let's get to it.
All right. Well, the first one was Warren Buffett a few days ago announced during the Berkshire Hathaway's recent earnings meeting that he'd be stepping down as CEO at the end of the year. He is 94 years old. He's been at Berkshire Hathaway for about 60 years and has skyrocketed the company's valuation by over 5.5 million% since he took over the failing textile company in 1965. Really incredible. Of course, he changed that textile company into a massive conglomerate that does insurance and energy and investing and a million things. They own Dairy Queen and they own Geico, a lot of other household name brands. They're a big investor in Apple and American Express. All of these companies, of course, he's been able to get favorable investments in and has done exceedingly well. Many people see him as the greatest investor that's ever lived, but now he'll be retiring. He'll be succeeded by Greg Abel, I'm not sure how to pronounce the last name, which is this man right here next to Warren. He's the current CEO of Berkshire Hathaway's energy division and the vice chairman of the non-insurance operations of Berkshire Hathaway. He's been in that top level position since 2018. I believe he's been with the company for a long time, though. Since they purchased, I think Berkshire Hathaway purchased Greg Abel's oil or gas company years ago, and then he stayed with the company. Honestly, I don't know that much about him, but he has big shoes to fill. I'm sure lots of people will be watching him, and hopefully the lessons, the structure, the theory that Buffett has not only passed on to Greg, but the entire team at Berkshire Hathaway likely still will see Buffett live on in his philosophy, even if he's not in the company as the CEO anymore. He'll still be there for the next few months. He's retiring at December 31st. In contrast, another CEO that might not be stepping down so gracefully is Elon Musk. On April 30th, the Wall Street Journal reported that the Tesla board had quietly started looking for a replacement for Elon. Of course, Elon Musk immediately, after seeing the article, went to Twitter and bashed the Wall Street Journal, saying that they deliberately published a false article. Of course, there's no way for any of us to really know. It is they had their sources that they did not name, which is not surprising. But we'll see if Musk ends up getting replaced. It will be difficult for Musk to be replaced since he does own 12% of Tesla and controls much of the board of directors. But it's understandable that the board of directors wants to replace him. If you remember back at the chart at the beginning of the webinar, the really bright red box in Tesla, Tesla stock shares are down over 30% year to date. So 30% in 4 months hurts. And a lot of that has to do to concerns over Elon's political involvement and the fear that it's irrevocably hurt Tesla's business. If you look at plenty of studies that say like who is most likely to buy an electric vehicle, it is more liberal people that do not agree with Musk's behavior. I've discussed in previous webinars about the anecdotal experience I have of friends that selling their Teslas and such. So we'll end up seeing if he ends up getting replaced or not, but it's hard to say from our point of view. We'll have to see what happens. All right, well, the last notable event for this webinar that I want to discuss was Capital One receiving final approvals for the acquisition of Discover. On April 18th, it was announced that they received those final approvals from all the regulatory agencies. It will make Capital One Discover the largest credit card company in the world after the deal closes in 11 days on May 18th. A lot of the fears that came with this merger was that, of course, it would lead to anti-competitive behaviors. When you have consolidation, especially of big players, there's less competition. And if there's less competition, especially in the low end of the credit card consumer market, usually subprime borrowers that have higher interest rates, if they have fewer places to turn, they might be able to charge higher interest rates and cause various problems. Of course, I don't see that as something that wouldn't happen. I think that could definitely happen. There's not much that regulators would probably be able to force them to change in the very, because sometimes in these mergers they can have requirements put in place for it to be approved. I believe they got an unconditional approval after showing their plan to invest money in various populated areas that are traditionally uninvested in, like that of banking deserts that don't have a lot of options there. But that's not the main part of why I wanted to discuss this. What I wanted to discuss was the potential for it to be actually adding competition to a different part of the market, which is Visa and MasterCard. So I think it's pretty undeniable that the merger will lead to anti-competitive behavior for credit card consumers. But on the credit card payment processing side, where it's common, it's like 2.9% of credit card transactions goes to Visa or MasterCard or whatever, whoever the processor is. Visa and MasterCard control 70%, over 75% of the market share. So that's a clear duopoly where two companies control the entire space. The other two big ones that, if you can call them big, I think they're at like 8% market share each, is Discover and American Express. Now, since Capital One before the merger was already one of the largest credit card providers, and they were using almost exclusively Visa and MasterCard payment processors, I could definitely see them over many years. It'll be a slow transition, but switching all of that to their newly acquired Discover payment processing. First off, it'll make them more money. It's self-interested. It'll be great for their shareholders, I'm sure, but it'll be interesting to see if that will drive down payment processing fees for credit cards, because Visa and MasterCard have no incentive to reduce fees. But if there's a third player who takes a big chunk out of the market because Capital One is a massive player in credit card issuers and is able to get the few holdouts, not very many, but the few places that don't accept Discover to accept Discover, and they're able to undercut some of the pricing of Visa and MasterCard, we could actually see it be a net positive for consumers. Hopefully, this is all hopeful, but seeing credit card processing fees plummet, which I've always kind of felt, I don't know if Gordon feels the same way, but I felt like 3% seems very high for just processing. Of course, there's fraud, and there's a lot of these providers have like zero liability if your credit card gets stolen. There's other costs other than just moving money from one place to the other. But I could definitely see this merger have big impacts on the payment processing space.
Yeah, it's interesting. I mean, I feel like merchants definitely bear the immediate cost
Yeah.
of the processing. And so if you're a merchant that most of your payments go through and probably cash is less and less used every year, then they bake that into their prices. And so more competition there would be disinflationary if it means merchants don't have to pay as much. On Elon, I would just, I'm the last person who would defend his actual behavior, but it's interesting, Tesla's stock price went up a lot at the end of last year based on the speculation that Trump, would be able to help Elon or Tesla or something, or his policies would. And I feel like there are still people who are holding on to that belief. So I feel like Tesla has more room to go down. But, I like to say that I make predictions all the time, but I don't bet my money on them. So, take that for not any kind of recommendation to short Tesla or anything like that. I just that's my best guess, and it'll be interesting to see what happens.
It is a good point. Like, we very much recommend diversified portfolios, so that you don't need to worry about whether or not a board is able to or recommends a CEO being removed or not. So having diversified portfolios, investing for the long term, historically has shown to lead to the best results, at least predictably the best results. I'm sure if you go all in on GameStop at the right time, you can make more money, but actually having a predictable long-term investment strategy is great. And if the nice thing also for our specific, for those clients that work with Silverstone, we are able to exclude specific companies from our portfolios since we use direct indexes. So if there is someone like Elon Musk that you don't like, you don't want to invest in their company, we have a number of clients that have specifically directed us to exclude that from their individual portfolio. So feel free to reach out if that is something that interests you. All right. Well, if any attendees have any cues, we would love to answer them. I haven't seen any come in so far. Hopefully that means we've been thorough, but we can wait here for a couple minutes if anyone has any questions.
And of course, reach out to us directly if you're watching this on our YouTube channel after the fact. And our contact information is on the YouTube page. And of course, either Silverstone Financial Fiduciary, is that the website?
Fiduciary.com is the...
Yes. or yourbestpathfp.com, which stands for financial planning. Either one. And we've got the contact information on either website.
Yeah. And I really appreciate having this first webinar with Gordon here. Well, hopefully we'll see him in future months. Also, last month was a great example where I was sick and I couldn't do it. Maybe in the future you'll see a Gordon only webinar if I am sick, or vice versa.
Just take a break, Jeremy. You work so hard.
I appreciate that. Yeah, sometimes I feel like it'd be nice to be able to just sit on a beach somewhere for a couple of weeks, but
yeah,
things to do.
It is nice. But I always wind up bringing my laptop just in case.
Just in case. And then I spend the whole time on my laptop. All right. Well, I haven't seen any questions come in this month. Like Gordon said, feel free to reach out if you have any other questions that pop up throughout the month, or if you have a personal question that we can't answer in a public forum here. But all right, until next month, thank you all for attending.
Thank you. Great to see you all. I'm proud to be part of this, and looking forward to next month.
All right. See you, everyone.